Good morning and happy New Year's Eve, everyone. I apologize for the scratchy voice. I've been dealing with a head cold for a little while now, but hopefully it's going away soon. I hope you're all doing great, and today's Money Not Math conversation brings you value as you head into the new year when it comes to your life planning, but also hopefully your personal financial planning as well. So today, I know in the past, I've highlighted the new what's called the Secure Act by Congress when they were talking about putting it in place. But now with the new 2020 spending bill, it was approved. So I just want to do a quick recap of what that means for us, some questions to consider as when it comes for you planning going forward, whether you're young and deciding where to put your money now, or entering retirement and deciding how you want to distribute your money going forward, or deep into your retirement and really thinking hard about how you want to leave money to your beneficiaries and your heirs. I think it's really important to understand how this Secure Act will affect you, because where you put your money today or where you plan, how you plan for your money today definitely affects how you can use it in the future. All right, so there's not really an article. I just pulled some information from our team website, and I'm going to highlight some of the points there. So I apologize, there's nothing really for you to reference, but if you have questions from what I'm saying, please let me know and I'll do my best to answer them, or at least provide some additional information for you to think about. So RIP Stretch IRAs, hello 10-year force out. Yeah, that is basically what we're calling it. So they call it the Setting Every Community Up for Retirement Enhancement Act. I'm going to say that again. The Setting Every Community Up for Retirement Enhancement Act, that's how they get SECURE, the acronym, was passed as part of the 2020 spending bill. I think that's hilarious. All right, so this is a perfect example, in my opinion, of Congress using a title called Setting Every Community Up for Retirement Enhancement Act. So the title sounds great. It sounds like they're trying to help you retire. However, in my opinion, they didn't do a single thing to help you retire. Everything inside this act, or not, I shouldn't say everything because I haven't read the act, word for word, page for page, but everything from my understanding that this act does, outside of allowing you to contribute to your tax-deferred 401k for an extra year and a half, age 70 and a half to age 72, congratulations, all it does is enhances their ability to get your money through taxes. Just this way, they're doing it through your heirs rather than through you, because they're hoping you won't think about it. All right, so I'll keep going highlighting what it means in case you haven't watched my previous videos. But again, I just think I'm using the word hilarious, but I think the word frustrating or annoying might be better used here. How they title something that in a way that makes you think they're trying to help you, but in reality, when you go into the fine details of it, it's just at the end of the day helps them get more taxes by taking more of your money. All right, so distribution rule changes. The Secure Act makes two significant changes to the rules surrounding distributions of defined contribution plans and IRAs. Defined contribution plans are like group plans that you have through your work that have tax advantages. So whether that's your 401ks, your 403bs, your TSPs, your TRAs, anything basically that you get through work that provides a tax advantage, whether that's tax deferring or after tax savings, and makes it a defined contribution plan, or an IRA, which is an individual retirement account, which again has a tax advantage by locking up your money. They push if it's a tax deferred account for account holders who turn 70 and a half after December 31st, 2019. So anyone who doesn't, sorry, you aren't grandfathered in. The age to begin taking minimum distributions is extended from 70 and a half to 72, providing for up to 2 more years of potential growth. I don't really understand the math there unless I'm reading that wrong, but 70 and a half to 72 is 1.5 years, not 2. So congratulations, the government waits 1.5 years longer to start telling you what to do with your money before they do so, but they're still going to end up doing it. Assuming you live to age 72, which hopefully we all do. The second rule, and again, sorry, to take a step back for if you've never watched any of my videos or listened to any of my podcasts, required minimum distributions are what happens when you have money in tax-deferred plans like 401ks, 403bs, IRAs, things like that, From age 70 and a half of current law, the government steps into your life and says, hey, you need to spend at least this much money so that they can get some taxes. Now what they're doing is they're just pushing that back to age 72, and now they're going to come in and use their calculations based off what they think your life expectancy should be, and they're going to tell you how much of your money you have to take, whether you want to or not, so they can get taxes. Okay? The second change, for IRA owners who die after December 31st, 2019, the inherited Stretch IRA for beneficiaries is eliminated. The Stretch IRA used to allow, so if Uncle Tom, or no, I should say, if Tom, the dad, passed away and he left $1 million to Timmy, his son, Timmy, under old law, could spend out that money that his dad left him over his entire life. So he could take a little bit each year over 30, 40, 50 years, so it really wouldn't affect his income that much, therefore not really affecting his income taxes very much. Government didn't like that, so what they're doing is they're eliminating the Stretch IRA. Now, if this happens after December 31st, 2019, so today, you get a 10-year period. All right, so if Tom leaves Timmy $1 million and Timmy spreads it over 10 years, that'd be about $100,000 a year. That's going to drastically affect Timmy's taxable income, which pushing him up to a higher tax bracket potentially, which increases the amount of taxes he has to pay, which increases the government's revenue. Somehow they title this as helping you retire, but really they just increase their tax revenue. Good job for them, not so much for you. Okay? Instead, IRA, so I just said a lot of this, but I'm going to just read it again anyways. Beneficiaries may no longer spread IRA distributions over their lifetimes. Instead, IRAs, Roth included, it's not just traditional IRAs, Roth included, must be distributed by the end of the 10th year following the account holder's death. There are exceptions to the 10-year force out, including surviving spouses have the same options as before. So spouses have different rules than kids, like heirs, right? Beneficiaries who are less than 10 years younger than the IRA owner may continue to use a lifetime distribution method. Disabled or chronically ill beneficiaries may delay distributions. Keep in mind they're using the words may here, so there's no guarantees. I'm sure you have to apply for it and meet certain limitations, things like that. But I don't know for sure. Please see your tax CPA. I'm not a tax planner. If you want more specific tax advice on this, I just help people plan around that. I can't actually give advice for it. So minor beneficiaries may delay the 10-year period until the age of majority. Okay, so another thing is to be aware of for those of you thinking, well, I don't have an IRA, I have a 401k. What typically happens for most people who have group retirement accounts is that while they're working and contributing to their 401k, it stays there. They contribute to the 401k, contribute. But once you retire, you're no longer working there. So most people, from my experience, I guess I haven't done a survey, but I believe most people then roll that money out of their group account into their own personal account so that for better management or for more specific management on their retirement goals. Because once you're no longer working at the group, their group 401k planners may not care as much about you. All right, so continuing on. During the 10-year period, there is no required minimum distribution. For example, a beneficiary could leave the entire amount in the inherited account until the end of the 10th year. The beneficiary would then take a lump sum distribution of the entire account. Alternatively, a beneficiary could spread distributions evenly over 10 years or any combination as long as the 10-year deadline is satisfied. Income tax impact. The 10-year force out is included in the revenue section of the Act. The message is clear. The force out is intended to increase revenue for the federal government. For example, if a beneficiary age 50 receives the account within 10 years as opposed to stretching it over 30 years, taxes will be generated more rapidly. The compressed distribution period could also push beneficiary into a higher tax bracket, creating a tax double whammy, increased income taxed at a higher marginal rate. IRA owners and beneficiaries should work closely with tax advisors to determine the distribution pattern that makes the most tax sense. In some cases, a gradual distribution pattern to prevent bracket creep may be advantageous, while in other cases, a lump sum distribution, taxpayers with large deductions in a given year, may be appropriate. Okay, so some questions to consider, or next steps to keep in mind. Sorry, my brain's moving a little slow with this head cold. Do not procrastinate. The SECURE Act delays the imposition of required minimum distributions, but it should not be interpreted as an excuse to delay retirement income distribution planning. The 10-year force-out rule creates a potential tax trap for those who fail to plan ahead. The new distribution rules raise several questions that all IRA owners should ask themselves now. Do I intend to use my IRA for retirement income? Do any of my IRA beneficiaries, primary and contingent, fall within the exceptions to the 10-year force-out rule? Do I want to pass any portion of my IRA to my heirs? Are my heirs concerned about income taxes now or in the future? Or are you concerned for them about income taxes now or in the future? Because a lot of times it's a lot harder for someone younger to think about future taxes than I think those who have gone through the different cycles of our government in the past. Are my heirs in a higher marginal income tax bracket than me, or will what I'm passing on to them push them in a higher bracket? All right, so the answer to these questions will help determine the best course of action concerning your IRAs and the use of other planning strategies, so please consider them. Please let me know if you have questions. Please let me know if this video brought you value. If it did, I'd appreciate you reaching out and let me know. That'd be awesome. But if you're not interested in doing that, please at the very least click like, or better yet, share this video or conversation, podcast, however you're listening to it or watching it with a friend. I really appreciate it. I hope 2019 was awesome for you and 2020 is even better. Thank you for your time, and I hope you have a great rest of your day, and Happy New Year. Thanks. Bye.